Good afternoon. I'm very happy to welcome you all to this historic building of the Bank of Greece. It is a great pleasure to have the President, the Vice President, and the Governing Council of the European Central Bank to this external monetary policy meeting at the Bank of Greece. It has been a rather long time, 15 years, since we last met here. It was a long journey since then. President Lagarde, in her speech last night, mentioned the great Greek poet, Kavafi, and said that during Ulysses' journey to Ithaca, he showed perseverance and resilience to arrive at his destination. But also, he learned a lot during his long journey. He became much wiser. What happened in the last 15 years is well known to all of us. It is now part of our shared common history. What is important is that we are all now wiser, stronger, closer to each other, better prepared to tackle difficulties, and, if I may say so, more European. Thank you. Wolfgang, you have the floor.
Thank you very much, Governor Stounaras. And we are joined here on stage in Athens by President Lagarde and Vice President de Guindos. My name is Wolfgang Preußel. We have participants via WebEx, via online, and if you ask questions, please turn on your camera and the microphone. And with that, I hand over to President Lagarde, please.
Thank you and good afternoon to all of you. The Vice President and I welcome you to our press conference, and I would like to begin by thanking Governor Stounaras for his kind hospitality and express our special gratitude to his staff for the excellent organization of today's meeting of the Governing Council. The Governing Council today decided to keep the three key ECB interest rates unchanged. The incoming information has broadly confirmed our previous assessment of the medium-term inflation outlook. Inflation is still expected to stay too high for too long, and domestic price pressures remain strong. At the same time, inflation dropped markedly in September, including due to strong base effects, and most measures of underlying inflation have continued to ease. Our past interest rate increases continue to be transmitted forcefully into financing conditions. This is increasingly dampening demand and thereby helps push down inflation. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. Based on our current assessment, we consider that the key ECB interest rates are at levels that, maintained for a sufficiently long duration, will make a substantial contribution to this goal. Our future decisions will ensure that our policy rates will be set at sufficiently restrictive levels for as long as necessary. We will continue to follow a data-dependent approach to determining the appropriate level and duration of restriction. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. The decisions taken today are set out in a press release available on our website. I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. The euro area economy remains weak. Recent information suggests that manufacturing output has continued to fall. Subdued foreign demand and tighter financing conditions are increasingly weighing on investment and consumer spending. The services sector is also weakening further. This is mainly because weaker industrial activity is spilling over to other sectors, the impetus from reopening effects is fading, and the impact of higher interest rates is broadening. The economy is likely to remain weak for the remainder of this year. But as inflation falls further, household real incomes recover, and the demand for euro area exports picks up, the economy should strengthen over the coming years. Economic activity has so far been supported by the strength of the labour market. The unemployment rate stood at a historical low of 6.4% in August. At the same time, there are signs that the labour market is weakening. Fewer new jobs are being created, including in services, consistent with the cooling economy gradually feeding through to employment. As the energy crisis fades, governments should continue to roll back the related support measures. This is essential to avoid driving up medium-term inflationary pressures, which would otherwise call for even tighter monetary policy. Fiscal policies should be designed to make our economy more productive and to gradually bring down high public debt. Structural reforms and investments to enhance the euro area's supply capacity, which would be supported by the full implementation of the Next Generation EU programme, can help reduce price pressures in the medium term while supporting the green and digital transition. To that end, the reform of the EU's economic governance framework should be concluded before the end of this year, and progress towards capital market union and the completion of banking union should be accelerated. Turning to inflation. Inflation dropped to 4.3% in September, almost a full percentage point lower than its August level. In the near term, it is likely to come down further as the sharp price increases in energy and food recorded in autumn 2022 will drop out of the yearly rates. September's decline was broad-based. Food price inflation slowed again, although it remains high by historical standards. In annual terms, energy prices fell by 4.6%, but most recently have risen again and become less predictable in view of the new geopolitical tensions. Inflation, excluding energy and food, dropped to 4.5% in September from 5.3% in August. This fall was supported by improving supply conditions, the pass-through of previous declines in energy prices, and the impact of tighter monetary policy on demand and corporate pricing power. Goods and services inflation rates fell substantially to 4.1% and 4.7% respectively, with services inflation also being pulled down by pronounced base effects. Price pressures in tourism and travel appear to be moderating. Most measures of underlying inflation continue to decline. At the same time, domestic price pressures are still strong, reflecting also the growing importance of rising wages. Measures of longer-term inflation expectations mostly stand around 2%. Nonetheless, some indicators remain elevated and need to be monitored closely. Let's turn to the risk assessment. The risks to economic growth remain tilted to the downside. Growth could be lower if effects of monetary policy turn out stronger than expected. A weaker world economy would also weigh on growth. Russia's unjustified war against Ukraine and the tragic conflict triggered by the terrorist attacks on Israel are key sources of geopolitical risk. This may result in firms and households becoming less confident and more uncertain about the future and dampen growth further. Conversely, growth could be higher than expected if the still resilient labor market and rising real incomes mean that people and businesses become more confident and spend more, or the world economy grows more strongly than expected. Upside risks to inflation could come from higher energy and food costs. The heightened geopolitical tensions could drive up energy prices in the near term, while making the medium-term outlook more uncertain. Extreme weather and the unfolding climate crisis more broadly could push food prices up by more than expected. A lasting rise in inflation expectations above our target or higher than anticipated increases in wages or profit margins could also drive inflation higher, including over the medium term. By contrast, weaker demand, for example, owing to a stronger transmission of monetary policy or a worsening of the economic environment in the rest of the world amid greater geopolitical risks, would ease price pressures, especially over the medium term. Looking at the financial and monetary conditions now. Longer-term interest rates have risen markedly since our last meeting, reflecting strong increases in other major economies. Our monetary policy continues to transmit strongly into broader financing conditions. Funding has become more expensive for banks, and interest rates for business loans and mortgages rose again in August to 5% and 3.9% respectively. Higher borrowing rates, with the associated cuts in investment plans and house purchases, led to a further sharp drop in credit demand in the third quarter, as reported in our latest bank lending survey. Moreover, credit standards for loans to firms and households tightened further. Banks are becoming more concerned about the risks faced by their customers and are less willing to take on risks themselves. Against this background, credit dynamics have weakened further. The annual growth rate of loans to firms has dropped sharply from 2.2% in July to 0.7% in August and 0.2% in September. Loans to households remain subdued, with the growth rate slowing to 1% in August and 0.8% in September. Amid weak lending and the reduction in the Eurosystem balance sheet, the annual growth rate of M3 fell to minus 1.3% in August, lowest level recorded since the start of the euro, and still stood at minus 1.2% in September. So, in conclusion, the Governing Council today decided to keep the three key ECB interest rates unchanged. The incoming information has broadly confirmed our previous assessment of the medium-term inflation outlook. Inflation is still expected to stay too high for too long, and domestic price pressures remain strong. At the same time, inflation dropped markedly in September, including due to strong base effects, and most measures of underlying inflation have continued to ease. Our past interest rate increases continue to be transmitted forcefully into financing conditions. This is increasingly dampening demand and thereby helps push down inflation. We are determined to ensure that inflation returns to our 2% medium-term targets in a timely manner. Based on our current assessment, we consider that rates are at levels that, maintained for a sufficiently long duration, will make a substantial contribution to the timely return of inflation to our target. Our future decisions will ensure that the key ECB rates will be set at sufficiently restrictive levels for as long as necessary to ensure such a timely return. We will continue to follow a data-dependent approach to determining the appropriate level and duration of restriction. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium-term target and to preserve the smooth functioning of monetary policy transmission. We are now ready to take your questions.
Thank you, President Lagarde. And the first question goes to Lefteris Papadimos of Reuters. Lefteris, please.
Hi. President Lagarde, what role did the recent weak economic data and the war in Gaza play in today's discussion? And secondly, did you discuss or at least begin talking about ending PPP reinvestment earlier or raising banks' reserve requirements?
Thank you very much. And let me take the opportunity of this first question to really express our appreciation for the extraordinary hospitality that the Greek National Bank, but also the Greek people that we have met here and there, have really deployed on the occasion of this visit. It has been a stellar organization and a tribute to the capacity of Greece in general to organize things and to make us feel welcome. So, Ekaristo. You ask me, I will start with your two last questions because in a way they are the most easy ones. Neither of these two questions, nor the PEP, nor the remuneration of required reserve, have been discussed at this meeting. You ask me about the current geopolitical environment and how that has weighed on our decision. I think we repeat 2 or 3 times in the context of this monetary policy statement the risks posed by the geopolitical environment and these aggravated risks as we see them unfold and develop. And of course, you have a special sentence in the MPS that refers specifically, in addition to the totally unjustified war of Russia against Ukraine, which refers to the tragic development as a result of the terrorist attack on Israel. We are monitoring the situation. We are very attentive to the economic consequences that that could have, whether in terms of direct or indirect impact on energy prices or the level of confidence that economic actors will continue to display. Thank you.
Thank you. And the next question goes to Annette Weisbach of CNBC. Annette, please.
Thank you, Madame Lagarde. I have 2 questions. I think on many people's mind is the question, how long is actually sufficiently long, and what will make you rethink and perhaps cut rates at one point in time? Is it at 2% inflation? Is it at 2.5? Is it at 3? I think that is something the market is interested in. And then my second question goes on your comments about the yields, which are on the rise as well in the euro area, and you said from other jurisdictions or from other regions, you're probably referring to the United States. So are you concerned about that rise in yields as well, and also about the potential fragmentation here? Thank you.
Thank you very much for your 3 questions, if I counted right. So how long is sufficiently long? You know, obviously we refer to timely manner, sufficiently long. But in the same breath, I say we shall be data dependent. And at this point of our fight against inflation, and after 10 successive hikes, now is not the time for forward guidance. Now is the time to really stick to our data dependency knitting, if I may say. And we shall do so. We have acknowledged on the occasion of this meeting that our assessment is confirmed, the assessment that we had in September. All numbers, if anything, have reinforced our assessment of the situation. We have applied the 3 criteria that you all know well, the inflation outlook, duly informed by any information that we have, the underlying inflation in all its compositions, and the strength of the transmission of monetary policy. So we will continue to be data dependent. Your second question was essentially when and at what level do you cut? This was not discussed at all, and the debate would be absolutely premature. You know, we have acknowledged in our review of the macroeconomic situation back in September and yet again this time around, and we all know, and you know, that labor cost, wages, profit units, the analysis of that is critically important to determine the inflation outlook. And we will continue to accumulate data. On labor, for instance, we are going to have a wealth of numbers and data and intelligence when collective bargaining agreement and annual negotiations in 24 will be completed. That is way into 24. That's only a for instance. And, you know, even having a discussion on cut is totally premature. For the moment, what we're saying is that we have to be steady, we have to hold. This is the decision of today. We are holding. Okay, so your third question had to do with this sort of external tightening, which is not directly relevant to the fundamentals of the euro area economy, but which are tightening element nonetheless, because they directly impact on how long-term yields and long-term rates as well. So that definitely is a spillover that we take into account, and that is compounded with other elements that clearly are bringing inflation down.
Thank you, President Lagarde. And the next question goes to Alex Weber of Bloomberg News. Alex, please.
Good afternoon. Thank you for taking my question. You said that you're seeing strong transmission of your past rate increases to financing conditions. Can you say how much of the impact has yet to hit the real economy and then on inflation? And then secondly, a follow-up on energy costs. I'm trying to understand how you would react to another spike in energy costs for example, as a result of conflict in the Middle East. Would you take the recent inflation episode as a lesson and immediately react to that, or could you afford to wait for second round effects?
Thank you. Those are interesting questions. I'll start with your second one, which is essentially, have we learned anything from the last energy crisis, the impact it has on inflation directly and indirectly, and would we apply the same approach? This is work that is ongoing and that we will continue to do. But it's clear to us that it applies to a completely different economy today, and an economy which has had an episode of very high inflation, an economy where the interest rates is at a very high level of 4%, and an economy that has strong employment and which is weakening. So we have to take all these factors into account to see how possible higher cost of energy would actually affect both GDP and inflation. And it's in the context of that assessment that we would respond accordingly. But be under no doubt, our determination is intact, and our determination to bring inflation to 2% in the medium term is absolutely the same, if not reinforced by the proximity of the destination. Your first question was the...
Strong transmission of...
Oh, yeah, of course. So what we are seeing is a very strong transmission of our monetary policy in the banking sector in particular. And the financing of the economy as a result is directly affected, which in turn plays onto the reduction of inflation and the dampening of demand. And those numbers are really, you have seen the bank lending survey, I'm sure, and they are very striking in terms of both volume and rate transmission. We know that there is still more to come. So as is often the case with monetary policy, there is this transmission lag time. The assessment by our staff is that there is still more in the pipeline and more to come to affect the real economy. And the assumption is that it will continue to unfold throughout the end of 23 and first quarter of 24. Now, one might argue that it's going to last longer, but we have already seen a significant transmission to the financing conditions. More is to come. And if you look at, for instance, the housing sector, it's pretty obvious that there is transmission to the real economy. If you look at the volume of capital expenditure, of investment by corporates, there is a reduction. It's not just the banks telling us that they will be more attentive to the risk and that they are reducing their flow of credit. It's also the corporates that are putting a brake on their investment because of the level of interest rates. That clearly results from the various corporate telephone surveys that we conduct and from the bank lending survey as well. So both in the housing sector and in the investment numbers that we have, it is transmitting to the real economy.
Thank you. And the next question goes to Eleftheria Kortali of the Greek website Capital GR.
Hello. President Lagarde, I would like to ask you a question on spread widening. Have you at all discussed spread widening, and especially the case of Italy? Italian spreads are now above 200 basis points, and I was wondering if this is a level the ECB is comfortable with, or it is considered to be a level of significant widening. And my second question is on Greece. Are Greek bonds now back to the ECB's normality? That is, are they now eligible for every purchase program when and if they are ever activated again? And are you confident that the Greek economy can return to normality? That is, where it was before the debt crisis, when it was rated A and A+ even? Thank you.
Thank you very much for your question, your two questions. Let me turn to Greece first and remind you that we only have one active purchase program that is operating at the moment, and that's the reinvestments that we conduct under the PEP. Under APP, we don't do any reinvestment anymore, so there is no question as to which country is eligible or not eligible. So Greece was eligible to PEP under a special waiver that had been decided at the time. Well, the good news is that the waiver is irrelevant. Greece does not need any waiver. The Greek instruments are eligible to PEP without any exceptions. So that's point number one. Point number two, Greece is now back to pre-COVID situation, and I speak under the control of my colleague and friend, Governor Stournaras, but Greece is actually higher than the level where it was just pre-COVID. And if comparisons are odious, but I will make an exception. Greece compares extremely well with other countries. And I'm saying that because we're in Greece. I'm not going to comment any further on who is better, because I don't want to comment on country-specific situation. I'll look at euro area numbers, but we are here in Greece. And Greece has demonstrated phenomenal recovery capacity, and it is, if I recall, 10% above the pre-COVID level at this point in time now. So I don't know what is normal or abnormal, but I have to say that it's a stellar performance. Would you like to add to this? And then I'll come back to your first question.
I fully agree, President, with what you have said. on activity were about 10% higher than the pre-COVID situation. The GDP growth is much higher than the average of the Eurozone. Spreads, they are within a range which we think it is quite normal. So all in all, it's a success story, as the President said in her press conference. But also, I do not deny that still there's a lot to be done until we get back to a rating of A+, as you said.
So on the first part of your intervention, let me remind you what we do. Our mission is price stability. We have defined it in our strategy review as 2%. We are not at 2%. The best tools that we can use to return inflation to 2% are our interest rates. And this is what we are using, and I just want to mention that the fact that we are holding doesn't mean to say that we will never hike again, okay? So at this point in time, on the basis of the data that we have, we are confident that the rates at 4%, well, I should say, the three rates at the level they are contribute substantially to bringing us back to 2% in a timely manner. But we are data dependent. Second point is that in addition to our stance, we also have to make sure that there is proper transmission of our monetary policy throughout the whole euro area and to all countries in the euro area. And we have all the adequate tools in order to make sure that that happens. Thank you.
Thank you, President Lagarde. And the next question goes to Martin Arnold of the Financial Times. Martin, please.
Thank you very much. President Lagarde, two questions from me. The first question is about central bank losses. So we've seen this week that the Riksbank, I know Sweden's not in the Eurozone, but the Riksbank has warned it will need 80 billion Swedish krona from the government to repair its balance sheet. Do you expect any Eurozone central banks to need similar kinds of capital injections? And the second one I'd like to ask is about PEP reinvestments. What's your view on the various calls we've heard from members of your governing council to say that those could be, the end of those reinvestments could be brought forward? Do you think that would be a risky move? Thank you.
Thank you very much for your two questions. So on your first question, I will not go into the specifics of each and every national central banks, because they are all in a different situation. Some of them are publicly quoted institutions, others are not, and there is no one-size-fits-all for the situation they're in. What I know is that as a Eurosystem and as ECB, we have one mission, which is price stability. And we do not have as a purpose to show profits or to cover losses. And it would be actually wrong if our decisions were guided by our P&L accounts rather than for pure monetary policy purposes in order to bring inflation back to 2% in the medium term. On your second point, as I said earlier, we have not discussed PEP on the occasion of this meeting. Thank you.
Thank you very much. And the next question goes to Silvia Berzoni of the Italian TV program Class CNBC. Silvia, please.
Good afternoon to all, President. Do you think that given the vigor of the monetary policy transmission and the added uncertainty of the war between Hamas and Israel that you just mentioned, ECB economic forecast might be a little too optimistic? Thank you very much.
Well, thank you so much for your question. I'm tempted to give you an appointment for our next monetary policy meeting, because obviously in December we will have a whole range of new projections, new numbers, and as is often the case, we revisit either up or down, depending on the situation. And once again, we're going to be purely data dependent. What we know for a fact is that growth has weakened. And if we look at PMI numbers, for instance, they are not indicative of a very vigorous growth, which is why I have clearly indicated in the monetary policy statement that growth continues to be weak.
Thank you. And the next question goes to Eric Albert of Le Monde. Eric, please.
Thank you very much. Good afternoon, Mrs. Lagarde. Just again, coming back on the bank lending survey, what you mentioned several times, the economy basically stagnates. I mean, is there a risk, are you worried that you've just been too far? Yes, the transmission will be slow, but you might have gone too far. And that's just one question, actually.
Yeah, it is one question.
Sorry.
No, that's okay. Well, I can only repeat what we say, and we actually repeat in the monetary policy statement, which is that we believe that the three rates where they are, if kept for a sufficiently long period of time, will actually make the contribution that is needed, the substantial contribution that is needed to return inflation to 2% in the medium term. And what we did on the occasion of this monetary policy meeting was to compare the September that we had in September when we made our decision, the new data that came in, including the inflation number, headline, and core inflation, including the bank lending survey, notably, and the various flash estimates and PMI numbers to confirm the assessment that we had previously. And let's not forget, our mission is to return inflation to 2%, to make sure that inflation does not cut into purchasing power of people.
Thank you. And the next question goes to Leonidas Exotsidis of Handelsblatt here. Leonidas, please.
Good afternoon, thank you. I would like to come back to the rising bond yields again, please. There is the point of view that the rise in the bond yields helps the central bank in the transmission of the monetary policy as financial conditions become more tightened. On the other hand, there are also people arguing that it can become a risk for the financial stability. Do you agree with both points of view? And do you think it can become more difficult for you to find the right balance in the future? Thank you.
Thank you. I'm going to share your question with the Vice President because he's the real expert on this panel on financial stability. But I just want to, again, remind you of what I said about the rising bond yields. This is a movement that originated outside the euro area. It is not directly related to the fundamentals of the euro area, and it is different, but we are facing the same circumstances that we feared back in March at the time of the various regional banks and Silicon Valley banks and Signature and First Republic collapses, where again there was spillover and the fear of more of it. But this is something that clearly impacts our own rates, and we take that into account.
Good afternoon, everyone. Well, in a couple of weeks, we are going to release our financial stability review. The financial stability review, is the document where we indicate the main financial stability risks that we have here in the euro area. And I would say that the increases in yields is something that we are looking at very carefully. Why? Because the main risk that we have identified in the past and that they could continue being identified in the near future is very high valuations of different kind of assets. And we have seen that when you look at these valuations, not only financial assets, as the President indicated before, we refer as well to the real estate market. Well, the increase in yields can give rise to an important correction. So this is something that we are taking into consideration very, very closely. And simultaneously, other factors that, the higher yields can have an impact, mainly on the non-bank financial intermediaries. There we have seen that there is a concentration of potential vulnerabilities in terms of liquidity risks or liquidity mismatches, in terms of credit risk. And this kind of situations that you have an important and pervasive increase in yields can give rise to additional problems for this part of the financial system. That is not totally isolated from the rest of the financial system. It has important liaisons and links with the banks. So the increase in yields is something that we are considering very closely. And we will make a lot of comments with respect, in our financial stability review about the potential impact that this might have in terms of financial stability.
Thank you, Vice President. The next question goes to Michalis Psilos of the Greek daily Naftemporiki. Michalis, please.
Thank you so much. Mrs. President, now that Greek bonds are eligible, as you said, would they be included in your APP portfolio? Should you pause QT and start reinvestments? That's for sure. And the second question, once upon a time, I would like to say the concept of saving was very important, but in most euro area, like in Greece, deposit rates are almost zero, and of course, well below from inflation, while lending rates have increased considerably. How do you comment on that, and what can be done to change this situation? Thank you.
Thank you very much for your two questions. On the first one, I'm tempted to tell you that I don't want to deal with hypotheticals. We are in a process of fighting inflation, of bringing it to 2%, using predominantly the interest rates and ancillary additional components that come as a complement, such as the gradual reduction of the balance sheet, as we have seen as a result of TLTRO reimbursement, as a result of non-reinvestment of APP. But I'm not going to have hypotheticals about what if after tightening, blah, blah. Suffice to say that Greece is today eligible to the PEP without any waiver. So it's, pari passu. Everyone in the group, the 20 member states, are in the same situation from that perspective. You asked me about the rates and the obvious gap between the lending rates by banks to corporates and to households and the remuneration of deposits. Our job at the ECB and at national central banks is to set the rates at which banks and other institutions finance themselves. Our job is not to set the rates at which they lend. We hope that they transmit that properly because that's part of the transmission mechanism, nor the rate at which they remunerate deposits. And this is an issue that occurs in several euro area countries, to which solutions are brought by either the authorities or by the power of consumers themselves or by the competition authorities. But this is not an area where the ECB or the National Central Bank can actually take action.
Next question, Andres Stumpf of the Spanish daily Expansión. Here.
Thank you. Madam President, you're a few days away from finishing your the first half of your mandate. I was wondering if there's anything you regret from these 4 years, and also if there's anything that makes you or have made you especially proud. And a second question, if I may. In Spain, the political parties are trying to form government, have proposed extending the new extraordinary bank taxes. And when the tax was announced, the ECB published an opinion advising against it. Should we expect another opinion, or have you got anything to say about this topic at all? Thank you.
Thank you for your personal question, and rest assured that I have no regret, okay? I'm not going to sing it to you, but there is a famous French singer that has done that much better than I could ever do it. So no regret. You know what happened today one of our members, after 12 years of loyal and good services, finished his term on the Governing Council, and it was his farewell Governing Council meeting. The level of warmth, of emotion, of acknowledgement that was demonstrated to him, and his response, reminded all of us around the table that sometimes we disagree. By the way, we had a unanimous decision on this occasion, just in case any of you is interested. Thank you. So while we disagree on occasions, because there is this common drive for delivering on the mission, we have a quality of debates, of exchanges, of different views. We try to convince each other on occasions, and we sometimes manage. That is something that is to be cherished. And in a world where, for dissenting opinions, people go into totally unconsensual and unrational directions, it's a gem. So that's for my personal take. I will not get personal again. That was it. So on the tax, maybe my Vice President.
Our assessment about bank taxes is well known. We have always said that this kind of levies, this kind of taxes should not impair lending, should not impair credit growth, and should not damage the solvency of the banks. And that was the recipe that included in our opinions for taxes that were approved in the case of Lithuania, Spain, and Italy. Well, in the case of Italy, we had different versions, no? And the final one, I have to say that it was more reasonable, no, in that terms, because they indicated that if they increase the capital buffers, then the tax will be reduced. So this is the approach. So I don't know whether what's going to happen, with the Spanish case, whether it's going to be extended or not. So let's see. But the principles of our assessment with respect to this kind of taxation is quite clear.
Thank you, Vice President. And the last question today goes to Klaus Rainer Jakisch of ARD Television. Klaus Rainer, please.
Good afternoon. Thank you very much for taking my questions. Mrs. President, some people speculate that we've seen the height or the peak of the current interest cycle. Can we interpret this from today's decision?
Sorry, the peak of what?
Of the interest cycles. Can we interpret this from today's meeting, or is still everything open? And the second question you have already answered partly. Can you give us a little bit of insight of the debate today? From the protocols of last meeting, one can get a bit the impression that the differences between the different groups of the Governing Council may have perhaps be a bit stronger than in the past. Is this interpretation right? Thank you.
Typically when you reach by unanimous consent a decision, you don't have a widening of the differences. And, together with colleagues who have been participating in all these hours of discussions here in Athens, I can assure you that there was a general, well-shared assessment of the current situation, the judgment that we have made, and the monetary policy decision that we took, which, after 10 different hikes over the last 15 months, is for the first time a hold. So it's, sometimes inaction is action, and a decision to hold is actually meaningful and was taken by total agreement of all governors and members of the Governing Council this morning. So if any of you wanted to add to that, but I think you have either a misinterpretation or strange information from inside our discussion. We were inside the rooms, and I can assure you that it was strong. Do you want to add something, Yanis?
No, I fully agree with what you said. It was a unanimous decision.
And as to your question on peak, I'm not going to pass a judgment to say that we are at peak. We are data dependent. And we are going to, meeting after meeting after meeting, assess on the basis of the three criteria of the inflation outlook, of the underlying inflation, and the strength of our monetary policy transmission, whether or not our interest rates are delivering sufficiently in order to help us reach the 2% medium-term inflation. Thank you very much.
Thank you. That's all for today from Athens. Next time is the 14th of December in Frankfurt. Until then, all the best and good afternoon.
And enjoy Athens as you're here.